Welcome to It's Your Dime, a straight talk interview series presented by SchiffGold. I'm your host, Mike Maharrey. In this episode, I'm talking to economist Mark Thornton, who predicted the 2008 housing crisis several years before it started. Mark holds his PhD in economics from Auburn University and is the author of several books, including the recently released Skyscraper Curse. In this episode of It's Your Dime, Mark and I discuss his book, how skyscrapers can help us predict economic crashes, the Austrian business cycle, why printing money out of thin air causes problems, and what skyscrapers are telling us about the condition of the economy today. Well, I'm here today with Mark Thornton, and really appreciate you coming on the show with me, Mark.
It's a pleasure to be here.
All right, well, we're going to start the interview with what I like to call, who are you and why are you on my show? Which is basically just your opportunity to kind of give everybody a little bit of your background, what you're doing now, and just kind of your credentials and whatnot.
Okay, fine. I was born in Geneva, New York, which is in the Finger Lakes region of New York, and I went to St. Bonaventure University in college where I was an economics major. And then I went to Auburn University in Alabama to pursue graduate studies in economics. I did earn my PhD, and I wrote my dissertation on the economics of prohibition, which was published as a book. And I worked in that area for 10 or 15 years. I still do write on that topic, but about 20 years ago, I turned my interest back to the business cycle, back to macroeconomics, and began working in the macro rather than in the micro area. And that culminated recently in the publication of my book on the Skyscraper Curse. I've worked in one form or another with the Mises Institute, which just happily showed up during my first year of graduate studies here at Auburn. And it's been an enormous, very lucky life to have come in contact with the Mises Institute at its very beginning, and to see it grow and mature and have influence really around the world from a very, very small starting point. And so that's where we're at.
Outstanding. Well, it's always interesting to me to talk to people who have veered into the Austrian school, because normally people don't fall out of the womb as free market economists, much less Austrians. How did you end up interested in that area, and what kind of brought you into that school of thinking?
Well, a couple things happened to me in college. One, I became an economics major, so I was very interested in that topic about how the world works. What makes it work and what makes it not work. Because as a teenager, I grew up during the 1970s when we had all sorts of bad economic things like going off the gold standard, price and wage controls, gas shortages, high inflation, high unemployment. And so that was certainly a factor. And also I recognized for the first time that my political beliefs were called libertarian. So I wasn't switching back and forth from Republican to Democrat, but this new word really helped me to identify myself politically and ideologically. And it was in pursuing both of those things that I went to an Institute for Humane Studies conference in the summer of my junior year. And I came into contact, one of the instructors was Roger Garrison. He did the economics lectures, and he did things like prices and price controls, but he also did a lecture on the Austrian business cycle theory. And that really captured my imagination because of what I was seeing in the US economy, what I was hearing about from the Federal Reserve, and it all started to make sense. And at that point, I decided I would go to graduate school. Ultimately, I did choose Auburn University, where Roger Garrison was teaching, and I planned to pursue studies in the Austrian business cycle theory tradition. And so I was coming into contact with the Austrian school finding out who the fundamental founders and creators of the Austrian school. It was a time when there was no internet, and it was very difficult to find any books for sale, or any books even in the university library about Austrian economics. So it was a real struggle at first, and there were a lot of other things I could have been doing, but ultimately I decided to cast my hat in that direction.
I think a lot of people uh, don't recognize the value of what we have today in terms of what is online, especially a resource like the Mises Institute, because, I came into this relatively late in life. And so, I was able to go download all of these books and read all of these articles by, people like Rothbard and Mises and Hayek and well, even you. And so it's amazing the resources that we have that weren't available even 30 or 40 years ago.
It really is. It makes everything so much easier. It creates a more level playing field. Uh, People can go anywhere around the world to our website, Mises.org, and download probably 1 million articles. Hundreds of books are available in PDF form and other forms. My book is available for free as a PDF file on our website. And so it's so easy to go online, get the book, read the book, cut and paste out of the book, and it's just a real engine of intellectual progress, both for the Austrian School of Economics and libertarian political philosophy, and all the old original journals and publications. We've brought all of that back from the past. Before I even got involved or knew of any of this stuff. And we've brought it forward, we've made it accessible, and people are using it.
Yeah, it really is amazing. Now, one of the things that I found really interesting about you is that you actually were predicting the housing crash even a couple of years before it actually happened, when nobody was paying a bit of attention to that. And I'm relatively certain you're not a sorcerer and you don't have a crystal ball. How did you manage to do that?
Well, I had several advantages. Remember from my previous statement, I said that I turned back to the Austrian business cycle theory. And one of the things that created that transition was reading about the skyscraper index. And so I was working on an academic journal's article on the skyscraper index right after the tech bubble bust. And so I was working on that subject, and the Austrian business cycle theory, digging down into the nuts and bolts of it. And a couple of anecdotes involving a friend of mine and involving a brother of mine made a light bulb go off in my head that said, hey, we're living through a housing bubble. We're living through one of these booms that I'm reading about and writing about. And this was probably in 2003. And so I began writing about the housing bubble in early 2004. And I was writing about the housing bubble in, in an academic sense, but also in a popular sense. I was giving talks to groups like the Economics Club at Auburn University, the Lee County Builders Association. I did some podcasts with LouRockwell.com, and most of the people thought I was nuts. And, this is a time when everybody was saying you can't lose money in real estate, that housing prices never go down. And this is true whether you looked at real estate associations and their economists, whether you looked at the Federal Reserve and what their economists were saying. Certainly Ben Bernanke was poo-pooing the idea, Alan Greenspan before him, that there was no likelihood of a housing bubble, that really wouldn't happen that it was just regional in nature, and that if there were a housing bubble, that the Fed could easily fix that. And so it was a lonely pursuit. We didn't really have big names like Peter Schiff, who was going to talk about it later. Ron Paul had talked about it much earlier, but wasn't really talking about it at this time. So it looked like I was out there on my own. And that was 4 years before anyone recognized that there was a financial crisis. And when the Fed really started to do some of its abnormal policies, which would later morph into untried and very speculative policies. But the housing bubble in early 2004 still had 2 more years plus to go. But in early 2004, the conditions were already there for an economic crisis to take place at some time in the near or distant future. And so, in fact, I wrote an article for a book in 2006 where I laid out everything with respect to the housing bubble and what would happen once it started to unravel. The publisher would not accept the book, and it would be until 2009 when it was published. And the editors of the book actually pointed out in the introduction that my article was written before any of this stuff happened, and it laid out the conditions of what the cause was, as well as what the implications were, and what were some of the ramifications once the bubble burst.
Yeah, you mentioned that in the beginning of your book, The Skyscraper Curse. And I want to get into that book here in just a second, but just to back up for a second for viewers who may not be as familiar, can you kind of give a real quick, maybe elevator version of what in the world is this business cycle? We talk about it a lot, but I think a lot of people may not really even know what that necessarily means.
Well, the business cycle basically is the ups and downs in the economy, the fact that economies expand at a very fast pace, and then they contract, sometimes severely in the downturn. But basically, in the upcycle of the business cycle, and you can call it a boom, you can call some of them bubbles. Basically, you have very high rates of economic growth. You have very low levels of unemployment. And there tends to be a lot of investment going on in the economy. Sometimes it's in one or two sectors. Sometimes it's a general increase in investment. And so everybody's doing well. Everybody's happy. Everybody's making profits. Wages are going up. So everything is great during the expansion. And but ultimately, this has to come to an end if it's generated by artificially low interest rates at the Federal Reserve. That's the ultimate cause. And once the boom runs its course, you end up in a contraction, some people call it. Some people call it a bust, or that can be severe and be called an economic depression. But the Austrian business cycle theory states that you get a business cycle because of artificially low interest rates by the Federal Reserve or the central bank. This leads to a big expansion in bank credit. So banks are making much more loans into the economy as a result. Not surprisingly, the banks have to lower their credit standards in order to give out this increase in the amount of loans. And when they lower their credit standards, obviously you're creating conditions where a lot of these investments are going to turn out to be bad investments once the money and the economy runs its course, and then you end up in the economic crisis.
So What in the world do skyscrapers have to do with this? You mentioned the skyscraper index. This is fascinating to me, and I really encourage people to get this book because it is really fascinating. But to the mind, you're kind of wondering, well, how in the world can building buildings have anything to do with the business side? Can you explain what all this skyscraper index is all about?
In 1999, I read an article about the skyscraper index, which was compiled by real estate analyst Andrew Lawrence. And he showed that there was a very unlikely correlation or association between the building of the world's tallest skyscraper and an economic crisis. And he did it historically. He went back to the Panic of 1907, the Great Depression, the stagflation of the 1970s, and other major crises, including the tech bubble. And he showed that every time there was a new record height in skyscrapers, that an economic crisis soon followed. And the business media at the time, and most every outlet at the time covered the release of this skyscraper index. It was kind of the story of the day, and most people dismissed it as just another one of those correlations that get talked about with respect to the stock market and the economy, like the Super Bowl index and things like that. But what I saw was the Austrian business cycle theory connecting those record skyscrapers with an economic crisis. And that's when I went about, starting my research on exactly what could I show, because it's obviously not the building of the world's tallest skyscraper that's causing the economic crisis, but rather both the skyscraper records and the economic crises are caused by artificially low, easy monetary policy by the Federal Reserve, and so that's basically what I was doing a lot of my academic research on. And in 2005, I was able to show in an academic journal article that Austrian business cycle theory links those skyscrapers with the boom bust cycle that ends with a crisis. And that's what the skyscraper curse comes from, is the subsequent crisis during that business cycle.
So I think back to some of the photos and stuff that you see that were popularized in the 1920s of the workers sitting on top of the girders and all of the building that was going on, particularly in places like New York City. What was the skyscraper that kind of is the signal before the Great Depression?
Well, of course, the Roaring Twenties was a huge expansion in the U.S. economy after World War One, and the Federal Reserve was founded in 1913, right before World War One, and they greatly expanded the money supply to help pay for World War One. And then the 1920s was really the time when the Federal Reserve sat down and tried to come up with a monetary policy, and they adopted the monetary policy guidelines of American economist Irving Fisher, who wanted to stabilize the value of the U.S. dollar in order to stabilize the U.S. economy. Unfortunately, Fisher's proposal had a lot of errors in it, and these errors were pointed out by Ludwig von Mises, the namesake of the Mises Institute. He published an entire book on the subject in 1928, and he showed that trying to use a price index to stabilize the economy is inherently unstabilizing. And he knew years before the Great Depression that the monetary policy that the Federal Reserve and other central banks were following were going to inherently destabilize the economy, and Mises turned out to be right. And so in the late 1920s, you had three skyscraper construction sites that would set new records. One was 40 Wall Street, which I believe is now called the Trump Tower, and then following that, the Chrysler Building would set an even higher record, and then finally, during 1929, they broke ground on the Empire State Building, which would set the record that would stand for decades. It opened in 1931 in the bottom of the Great Depression. We had 25% unemployment rates, much higher in manufacturing areas. And so, yeah, the skyscrapers, you can imagine what New Yorkers were thinking, because it wasn't just these three record-setting buildings that were under construction, but all sorts of things were being constructed on Manhattan and elsewhere in the economy. And there was really technological and product revolutions going on, a lot of advanced technology coming online. And so it was a revolutionary time, really, in New York City. It had become really the economic hub of the world post World War I.
So I'm sure you're familiar with the old adage, correlation does not necessarily equal causation, but you actually show uh, what specifically the monetary policy and how that actually does correlate with certain things in the construction industry. Can you give one or two examples of why buildings get built higher during these times of boom?
Sure, that's what I was working on in, say, 2002, 2003, 2004, and what I came up with was three Kantian effects, which were effects named after a very early Irish economist named Richard Kantian, who I was also working on other areas of his work. And basically, low interest rates, they do a lot of things, but they do a lot of known things that are somewhat mainstream economics. These are things that are well understood. And one of them is that low interest rates cause land prices to increase. If the interest rate is on your account is zero, and you've got pieces of land that you're holding, you're less likely to want to sell that land and put the money in the bank. And so if you suppress interest rates, one of the things you do is increase the price of land. And when you increase the price of land, you have to be able to produce more square footage on that land in order to make the project viable. And so when the price of land goes up, the height of buildings goes up right along with it in order to make construction projects profitable. So that's one thing where the interest rate directly affects the height of buildings. The second thing is that low interest rates encourage companies to become bigger, companies to merge together, companies to acquire other assets to become bigger. So you see a general movement from mom and pop operations to conglomerates and corporations. And the transition from mom and pop operations to corporate conglomerates means that you're basically serving the same number of consumers, or maybe more consumers, but the firm looks entirely different. Mom and pop firms don't have marketing departments, they don't have human resource departments, they don't have product development departments, all sorts of headquarter type operations mom and pops don't have, but these larger corporations do. And so these larger corporations need more office space, and they need that office space in central business districts. And so that increases the demand for office space in areas where the price of land is very high. So that also stimulates artificially entrepreneurs to build bigger structures. And the other category of Cantillon effects is, what do these low interest rates and taller structures do to construction technology? Well, when you're building a record-setting skyscraper, you basically need all sorts of new construction technologies in order to make that building viable. So so you're pumping concrete, you're moving labor and materials to higher positions. Right here in Little Auburn, Alabama, we can see this business cycle in action. They're building, they're only 7 stories high, but that's still a local record. And so we have all sorts of cranes and pumping devices. And so the construction industry has to change across the board with advanced technologies, and then building technologies or building systems. And here we're talking about water and wastewater, heating and air conditioning, elevators and escalators. All of that has to change as well. For example, on one recent record-setting skyscraper, they would have needed a cable to move the elevator using the old method that would weigh 24,000 pounds just for one elevator. And so a company came up with an advanced technology where the elevator cable only weighed about a little over 2,000 pounds. And so what's going on in the skyscraper is that all sorts of new technologies, all sorts of new production techniques have to be brought to bear in order to set these new records. And so the skyscraper is a really good illustration, really, of what's going on throughout the economy, because those subtle changes are happening in businesses throughout the economy. Maybe not every business, but most industries are going to be impacted by that.
The thing that I really like about this book, and one of the reasons I recommend it, is that it's interesting because people kind of think, oh, economics, dry. But just, as you were just saying, when you start putting these things together and things that you see in the real world, I mean, we can drive down the street and see the buildings going up and the, the various construction techniques. We see all that. Then to be able to connect that to what is probably more abstract economic theory, I think it makes it a lot more understandable. So if you're sitting out there watching right now and thinking, I don't want to read about economics, this book is not boring. It is actually quite interesting because it really does bring it brings things into the real world, so to speak. One of the things I thought was interesting, you've got a chapter in the book and you talk about these Kantian effects, and you talk about it particularly in terms of the impact of printing money and how that money printing, we've had a lot of money printing over the last decade, how that impacts entrepreneurs in particular, and the average person even. Can you kind of give a little brief overview of that?
Well, first of all, I'd like to thank you for your kind words regarding my book. One of the things that I absolutely demanded of myself was that I would write this in a non-technical way, something that most everybody could read and understand, but especially if you had any experience with the construction industry, the real estate industry, entrepreneurship in general. And also I tried to lay out my case and where I was coming from in a very open way, and in a way that would help explain why, not just that the Austrian business cycle theory is a great theory, but also why it's not widely accepted and why it's very often chastised in various ways. But it also deals with this fundamental issue of printing money, easy monetary policy, artificially low interest rates by the Central Reserve. Most everybody knows that if you print a lot of money, if a government prints a lot of money, that eventually the prices of the goods and services that we consume are going to go up. Monetary inflation leads ultimately to price inflation. And a lot of people, especially during this cycle, have not seen much in the way of higher consumer prices. And most people know that the Fed has been printing trillions of dollars, but they've been printing it in a way that the money goes into financial assets and financial markets. So that what's happening so far is that the Fed's policy has increased stock prices, it's increased bond prices, it's increased land prices, it's increased real estate prices, and other assets. And so far, the monetary inflation has gone into asset price inflation rather than consumer price inflation. But in addition to the inevitable price inflation, you also get the business cycle as a result. The Fed undertakes an easy monetary policy that they think is going to stimulate the economy and bring us out of recession. That's also a very misguided type of monetary policy. The market economy can always recover on its own without the need for monetary stimulus or federal spending stimulus. Those things just aren't necessary. But the thing that they do, and I repeat this throughout the book, is that monetary stimulus in the form of lower interest rates and more bank credit causes an overinvestment, or really more accurately, it causes people to invest in the wrong things. It causes people to invest in advanced technologies. And, advanced technologies seems like a good idea, but just because it's advanced doesn't mean it's the right technology. We might adopt it 10 years from now or 20 years from now. But if you do something too soon, it's just as bad as investing too late. And so what comes unraveled after the boom is you get this cluster of entrepreneurial errors, and so it's not just that one restaurant is going out of business, or one bank is going out of business, or one house is being foreclosed on, but no, it's people throughout industries are all going bankrupt or getting foreclosed in large numbers at a particular point in time. And so that cluster of entrepreneurial errors are actually what was started with investments in advanced technologies a few years prior. And that's basically what the Austrian business cycle theory shows. And it's really consistent, I think, in terms, once you start breaking aggregate numbers down into industry numbers and into different categories, the types of things that the theory expects actually do come true. And so very often it's the cluster of entrepreneurial errors involves financial institutions, it involves technology institutions, and it involves real estate type institutions or adventures, rather than like Coca-Cola going bankrupt or Johnson & Johnson going bankrupt. So when the bust comes, it doesn't totally wipe out, for example, consumer good producers. It usually hits investment and interest rate sensitive sectors of our economy. And that can tell you, where to go, where to hang out and wait for the crisis to be over with.
Yeah, that makes complete sense. So obviously we're in a tightening cycle right now. We went for almost a decade with virtually 0% interest rates. The Fed has been nudging up rates, and of course we also have the the factor that the federal government is run up so much debt that it's selling boatloads of treasuries, which of course is pushing treasury yields up. So we're in an environment of increasing interest rates right now, and we're in a high debt environment. Everybody's leveraged up, governments, individuals, corporations. So people that follow the SchiffGold blog over at schiffgold.com/news know that I've been hammering on this subject for several months about the it's really difficult to sustain a in-debt economy in an environment of rising interest rates. So I've been saying that I think we're near the end of the boom, that we're heading towards a crash. And of course, you mentioned in your book, and I think it's important to emphasize this, we don't have a crystal ball. We're not making predictions, but you can make observations based on the things that we see in economic theory. And I think there's a lot of people in our camp, certainly, that think we're getting close to the end of this cycle. But so I'm sure the question is burning on everybody's mind is, are there record-setting skyscrapers in the work right now?
Yes, there is.
I'm shocked.
Well, the point about prediction is that scientists, like in physics and math, they can make predictions. Halley's Comet came back and crossed through our solar system just when Sir Edmund Halley predicted it. And, that can be done in factories. It can be done, in the physical world of rocks and metals and gravity. But it can't be done in the world of human beings making choices, changing their mind, changing taste, new product lines, and all the rest. So the Austrian business cycle theory gives us a general idea of what the business cycle is and what causes it, so that we know with pretty good certainty when a crisis could take place. But it doesn't give us any tools by itself as to when it's going to take place or what the magnitude of the crisis is going to be. At this point in time, I think, given the monetary expansion, 10 years of extremely low interest rates and untested monetary policy, the conditions are probably overripe for an economic crisis. With respect to skyscrapers, the Jeddah Tower has been started in Saudi Arabia. It is designed to be 1 kilometer tall and to break the record by about a dozen floors of livable space. That construction project is actually on hold because of all of the corruption scandal that's going on in Saudi Arabia, and of course the current situation with Saudi Arabia. But it doesn't really matter that the skyscraper has been suspended, because again, it's not the skyscraper that causes the crisis. It's the conditions of monetary policy that cause people to do these sorts of things and to have to invent new techniques and new technologies in order to get all that done. So the projection of that construction project had it opening in 2020. And so the crisis should be in full bloom by then. I think we're seeing the beginnings of it, moving the target interest rate from near 0 to 2% is already causing more volatility in stock markets. And stock markets are the markets that move the quickest. I mean, you can basically open the stock market one day and things can look incredibly different by the end of that day. Things are slower in, for example, the real estate market, where buying, selling, and setting prices on real estate assets can take years to really come into equilibrium. And so I think what we're seeing right now with the increased volatility in the stock market is the initial stage of the turn in the stock, it's in the stock market, but also in the economy and in the business cycle. I think we're definitely headed in that direction. I think we're headed in the direction of higher costs, higher commodity prices, higher gold and silver prices. If you look at the market in a technical fashion, um, I think the precious metals and commodities in general are well set for a stage of higher prices. And this just makes all of those investments harder to become profitable as we see them being constructed, invented, and once they are all brought online, what we typically see is, well, there's overcapacity now that we bring on all these, whether it's computer chip making factories or houses or luxury game day condominiums. The capacity is more than anticipated. The costs are higher than anticipated. And so profits are going to be a lot less than entrepreneurs anticipated. And that starts to snowball, and the economy goes down the drain with more unemployment, fewer profits, more losses, business shutting down or curtailing operations. All of those things I think are very ripe to happen when you look at just the numbers that are there. They're obviously out of equilibrium, and I think what we're seeing right now is the first movements towards equilibrium, which means we move from the bubble to the bust.
Yeah, I agree with you, obviously. And, Peter Schiff has been talking about that in terms of the stock market. And I think it's interesting just to note that, we're at roughly 2% as far as the Fed interest rate goes. That's not very high. It's interesting that we're already having this kind of volatility, and really, it's still what I would consider abnormally low interest rates. So I think you're right. I think we are in the beginnings. But again, not making a prediction that's going to happen tomorrow or next week or whatever. But the conditions are certainly ripe, and I I I saw that overcapacity firsthand. I lived in St. Petersburg, Florida, in '06, '07, and they built 800 billion apartments and condominiums, and then I went back and visited, 2010, 2011, and there was 850 billion empty condominiums and apartments because they just during that boom phase they just way overbuilt, and and apparently they're building again down there. So take that for what it's worth as well. So I've got one more question for you. This is the most important question of the show. This is going to determine like whether I ever invite you back again. All of those important things. Um, if you are typing a something that you're going to publish online, do you double space after every sentence?
Yes, I do.
Ugh, I'm sorry.
Sorry.
I'm gonna have to end this interview. I'm not gonna even let. I'm just kidding.
Well, if it's an email or if it's a comment online, um, I'm not double spacing. But if I'm writing something that's an article length piece, I usually do that first in a word processing package using double spaces. And the reason I've done that all along, but the reason I do it now is because I can't see the words as much.
Well, that's fair.
But
I'm beginning to
I
experience
do
that
want
myself.
to agree with you about the debt issue because, I said costs are starting to rise, and one of the most important costs that's rising and going to rise further is the interest rate. And we know that's going to be true, not really directly by what the Fed plans to do, but in terms of interest rate setting policies. But they're also in a quantitative tightening phase where they're supposed to be selling off US government bonds and mortgage backed securities. They accumulated over $4 billion of those assets, and they're supposed to be selling those back into the marketplace. And you combine that with a rising federal deficit, it means that the demands on the Treasury market are going to be very difficult. And I can only see rising interest rates as a result. And that is, of course, the big ticking time bomb of the debt bomb that comes along with the economic crisis.
Yeah, it's interesting. I just saw an article this morning, and haven't dug into it, but the headline was that for the third straight month, the Chinese have decreased the number of treasuries that they're holding. So typically, when the Fed or when the U.S. Treasury is selling these bonds, the three biggest buyers are the Chinese, the Japanese, and the Federal Reserve, or at least that's been the case for the last decade. And so now you've got the Fed; they're not buying. The Chinese aren't buying, and the Japanese buying, and that raises the $64,000 question: who's going to buy all of these bonds? And it goes right to your point that simply means that you're going to have lower bond prices and higher yields in order to try to get people to soak up that demand. And I read that the Treasury had planned on selling, I think, $1.4 trillion in Treasuries this year, and they expect that pace to continue into 2019 and 2020. So the amount of debt that they're trying to sell onto the market right now is amazing. And like you said, no matter what the Fed does, that supply and demand dynamic is probably going to push those interest rates up. Well, before we go, and I really appreciate you taking the time to talk with us today, and I just want to give you an opportunity before we go to let everybody know where they can find Mark Thornton, so you can give all of your links and social media and whatever things you want to share with us.
Well, our webpage is Mises.org, MISES.org. It's one of the largest and most trafficked economic websites in the world, and it's written for everybody, not just academics. And we're open 24/7, 365. There's no registration. You can subscribe to various things, but there's typically no fees unless you wanted to purchase a hardback copy of my book or something like that. Most of the books that we publish are available online for a free PDF download. So you get a chance to look at something that you might be interested in buying. I'm on Twitter at Dr. Mark Thornton. And of course, the Institute has a Facebook page and is active on Twitter and all sorts of social media. And we have daily articles and a blog. And so there's a huge amount of material. We're always commenting on the economic and sometimes political news, and we're providing the Austrian vantage point for these issues, so that if you come to our website and look up issues on our website, you're going to find a completely different take than if you look at the mainstream media. When I look at the mainstream media today, I am baffled as to how they can continue to exist, because there's very little explanatory content to what they're reporting, and that's what our website does. And so I encourage everybody to go take a look, maybe subscribe to our daily subscriptions and things like that. We have years of audio and video lectures on virtually every topic, so it's an entire universe unto itself.
I will second that. The Mises website is one of my daily stops, actually multiple times a day. And I can't emphasize enough how much is available in terms of, if you want to study, if you want to learn Austrian economics, if you want to learn libertarian theory, there are hundreds and hundreds of books that you can download and read. It's an amazing resource, and I love it and encourage people to visit that website. Well, Mark, I really appreciate it. I have to ask you, are you as much fun on Twitter as Tom Woods? Are you engaged in the perpetual Twitter wars?
No, I don't battle on Twitter. I try to provide information. Tom, I follow him on Twitter. He's great. I've been on his show many times. He used to be right in the office next to me for several years, and that was one of the pleasures of my life. And he does great work in helping libertarianism straighten itself out, promoting Austrian economics, and challenging the mainstream media on a daily basis. I'm glad he's on our side and not on their side.
For sure. For sure. Well, Mark, I really appreciate again you taking the time, and everybody check out Mark's book, and I appreciate it. And you have a great day.
Thank you, Michael.
You've been watching It's Your Dime, an interview series presented by SchiffGold. For more information on investing in gold and silver, talk to a SchiffGold precious metal specialist today at 1-888-GOLD-160. That's 1-888-465-3160. Or visit us on the web at SchiffGold.com. You can keep up with all of the latest precious metals news at SchiffGold.com/news. And tune in each week to the SchiffGold Friday Gold Wrap podcast. This is your host, Mike Maharrey. I appreciate you watching, and I'll talk to you again next time.